In January 2018, a stress test was introduced which will change how home buyers and real estate investors qualify to borrow money. I'm here today with Dalia Barsoum, an award-winning mortgage broker, real estate investor, and finance advisor with over 20 years' experience in the banking sector. She is also the author of Canada's best-selling real estate financing book and Amazon bestseller, Canadian Real Estate Financing: 7 Secrets to Getting All the Money You Want. Dalia, welcome.
Thank you, Rachel. Thank you.
So, I've heard a lot of people stressing out about this stress test.
Well, that's why it's called the stress test, yes.
Totally makes sense now. But before we dive into talking about the stress test, I'd like to take a step back and ask you, what is your mortgage brokerage really about? Who do you cater to?
So Streetwise Mortgages is a boutique mortgage brokerage based in Vaughan, Ontario, and we do business all over Ontario. And we work primarily with real estate investors who are starting out or those who would like to take their portfolio to the next level, as well as self-employed clients that typically get turned down by banks because they don't show enough income. And finally, we work with a smaller segment of clients who are working through a divorce or separation.
Single moms.
Yes.
So let's talk about the stress test. What is it?
Okay, so in a nutshell, the stress test is a new rule to qualify borrowers at a higher benchmark. What that means is the banks, regardless of the rate that you're going to get from a bank, let's say you're getting a 5 years fixed rate at 3%, and your payment works out to be $1,500 per month for that mortgage rate. What the banks are going to do tomorrow is make sure that you qualify at a much higher payment. And that payment is going to be calculated as follows. If you're getting a rate of 3%, they're going to take the higher of Bank of Canada rate, or 2% added to that 3%, which is 5%. So essentially what they're doing is, regardless of what your actual mortgage payment is, they're making sure that you qualify to pay, you're able to afford a higher payment in this exercise.
So my husband, who's very risk averse, actually really likes this new stress test, and he's thinking it's a welcome addition to the whole process. I think he's probably one of the only people that feels that way. Yeah. But nonetheless, I think it does make sense in some cases. So by way of example, if I qualified for a $500,000 house before the stress test, what would I qualify for after the stress test?
Okay, so generally speaking, there is going to be about 20% impact on affordability. So if you today, if you're buying a $500,000 home and you qualified for a $400,000 mortgage, under the new guidelines for that same house, you would qualify for only a $320,000 mortgage. Having said that, this is not a widespread rule. It really depends on the personal finances of the individual and whether they qualified under a fixed rate or a variable rate.
Okay, so there are a few caveats, and I think we'll come back to that. But I first want to jump into figuring out what is going to be the impact to the rental market.
So because of the impact to affordability, what I think is going to happen is we're going to see a more balanced market in the sense that back in March and April and February, we saw a lot of competitive offers. It was more of a seller's market. And I think after this rule kicks in, that market will become a more balanced buyer-seller's market. So that's number one. Number two, from a rental standpoint, again, because of the impact to affordability, I think people will rent for longer and there will be more demand for rental properties until they save up a higher down payment or until they work out their finances to qualify for what they want to qualify for.
So if you're an investor, things are actually looking up.
Yes, yes, absolutely. Absolutely.
So does the stress test affect your first-time investor differently than it would affect someone who already has a few properties and wants to add to their portfolio in 2018?
Not really, because at the end of the day, how you qualify depends on your personal finances, meaning your income plays a role, your debts play a role, your credit plays a role, as well as the rental income you currently have. So everyone is different. And it really boils down to having a plan in place or a strategy in place that continues, that would help you qualify given your individual circumstances under these new guidelines. So it's not a again, generally speaking, affordability will be impacted, but it really boils down to how everyone's finances look like.
So as you know, I focus on rent-to-own investments, and of course my colleagues at Mothers of Real Estate, Jillian focuses on student rentals, Monica focuses on buy, rent, holds. Does the stress test affect us differently because we focus on different strategies?
No, it has nothing to do with the strategy.
So what exactly is being impacted?
So at the end of the day, to qualify, it's a function of your income and your debts. And everybody's debt level is different and everybody's income is different. So these are the levers that we have to work with for each client to make sure they continue to qualify for what they want to qualify for.
Even if we're operating our real estate investing business as a business?
Yes.
So individually is really what determines how we can boost our borrowing power.
Yes, if you're a real estate investor who's buying a residential property, so that's a single family house, duplex, triplex, and fourplex, your personal finances drive what you're going to qualify for. And that's why the focus will be on how we can work with your personal finances from a debt and an income standpoint to keep your portfolio going or to help you qualify for the properties that you wanted to qualify for under the old guidelines.
And you have a recommendation. There's in fact four specific strategies that you recommend for people to start thinking about in order to boost their borrowing power.
Yes.
Why don't we walk through those right now? So the first one I find quite interesting. It actually starts making you think a little bit more about the debt you're carrying and taking inventory of your debt.
Yes.
Can you tell us a little bit about that?
Absolutely. So the first strategy is about restructuring debts that are standing in the way of you getting a good rate or getting to borrow the loan amount required. So to give you an example of what these debts are typically, we're talking here about unsecured lines of credit. So these are lines of credits that are similar in nature to credit cards that, yes, on a daily basis you're paying interest payment on it, but in the bank's eyes, they calculate payment at a higher rate. So they typically stand in the way of getting an approval. We're talking about large car payments, whether it's a lease or a financed car. We're also talking about big balances on secured line of credit. So if you have taken out equity in the past against your house through a secured line of credit, which is a very effective strategy if you deploy this money strategically in real estate and you have a big balance on that line of credit, as much as you're paying interest-only payment on it, the banks, again, are looking at it differently. To give you an example, if you have $100,000 of secured line of credit and the interest is 3.7, which is prime plus half, your interest-only payment is going to be around $300. But in the bank's eyes, you're paying close to $600.
Wow.
So that, as much as we think it's $300, the bank looks at it differently, and therefore that payment alone could stand in the way of you getting your next mortgage.
So it seems to me that the average investor or home buyer would have absolutely no clue how to look at their debts in such a way that they would know what needs to be restructured.
Yeah, a prime example of that is getting 0% financing on some credit cards. For example, there are clients that love it and say, you know what, it's $10,000, but I am paying 0% interest. In the lender's eyes, they take 3% on that $10,000, so it's the equivalent of a $300 payment. So two different sides of things.
So you definitely need to have a mortgage professional help you look at the debts you're carrying and figure out strategically what needs to be.
Absolutely.
And you need that second set of eyes, because I would have never known how to, in my eyes, zero interest is a good deal, but not when you want to borrow money.
Absolutely.
So the second strategy that you recommend, I find quite interesting, because it might actually involve us paying just a little bit more taxes.
Yes.
What do you mean by that?
So the second strategy is called boosting the reported income. Remember, we're dealing with two levers here, the debt and the income situation. So we want to focus on both to continue to qualify under the new guidelines. So this one is called boosting the reported income. And what I mean by that is basically reporting sufficient income on the personal tax returns, especially for the self-employed clients who have great businesses that make money but don't pay themselves as much on the personal level to save taxes. From a lender standpoint, they care about how you personally pay yourself and how much you pay yourself, not as much how well your business is doing. So for self-employed investors in particular, we want to talk about the trade-offs of saving on taxes or getting a mortgage or opening up borrowing power on the mortgage side. And that's where we have to crunch some numbers and say, here are the trade-offs. Where do you want to play, here or there?
So is this something that you would now have a conversation about in tandem with a mortgage professional?
Yes.
And your accountant?
Yes, we typically have this conversation with the client and their accountant as well.
Okay. So the third strategy involves minimizing mortgage payments. So what is that all about?
So some clients, especially on their personal home, and I know it's really psychological, they want to pay down that mortgage on their personal home as fast as they can. And the way they go about it is sometimes by doubling up their monthly payments. So they utilize all sorts of prepayment privileges, which is great. One of them is doubling up the monthly payment. And now, in the lender's eyes, you've got double payment, which again loads up your debts and makes the numbers look worse from a qualification standpoint. So one of the things we talk about is maybe we should slow down temporarily on paying that mortgage as fast as you want it to, and to open up room on the borrowing side. And then you can resume paying it later on if you want. That's one thing. The other thing too is sometimes we can restructure mortgage payments by re-amortizing the loan. So again, the objective of this whole exercise is to bring down your monthly obligations, to open up room under the new guidelines to borrow for what you want to purchase.
So in my mind, I'm thinking if I am basically slowing down how quickly I pay down a mortgage, my cost of borrowing is starting to creep up a little bit.
Yes.
But you're suggesting that this is really a temporary strategic move,
yes,
to get us to where we need to be to qualify for a mortgage for a particular property, and then we can then rejig things to go back to the same routines that we had before.
Yes, that's one way, but there are also other strategies to pay down a mortgage very fast other than doubling up payment. One of my preferred strategies is to actually take a lump sum and utilize your annual lump sum payments, because that goes straight towards principal versus getting split between interest and principal. So yes, you're giving up doubling up payments, but if we focus on some other strategies, we can still achieve that same goal of paying your mortgage as fast as you want it to without impacting your borrowing power if you want to invest in real estate.
Best of both worlds.
Best of both worlds.
Love that.
Yeah.
And the fourth strategy that you recommend is all about maximizing rental income.
What we're referring to here are two things. Number one, if you are getting rental income, let's say from a basement in your house, please ensure that all of the rental income you receive is getting reported on your tax returns. Because the lenders will go by, a lot of lenders will go by what you report on your tax returns as rental income. So I highly recommend that any rental income received, whether from a basement, from a room, rental, gets reported on the tax returns. Airbnb gets reported on the tax returns. That's number one. Number two is more about working with banks or lenders that will factor majority of that rental income that you're receiving. So let's say you're renting a unit for $1,500 a month. Behind the scene, the banks look at that rental income differently. Some banks will use only 50% on your application. Some banks will use 80%. Some banks will use 100%. You really want to work with mortgage professionals that understand income property financing so that they can take your deals to the lenders that will maximize on that rental income, because it's only going to help your qualification. So that's what we refer to under that strategy.
And truthfully, I have firsthand experienced the magnitude with which you bring expertise to the table in these specific scenarios. You know, a lot of people max out very quickly with some of their traditional ways of getting a mortgage. And the expertise that you have brought to various projects and people that I have been involved with has blown me away. And you just got it done, and you made room for people to be able to borrow, not just for that particular deal, but for more deals to come, which I think is a very important skill, and there's very few experts in this industry like you. So I have to say I benefited from that directly. Now, investors looking to grow their portfolio in 2018, what's the first thing that you suggest they do?
The first thing I suggest anybody does, whether they're buying an investment property or buying a house to live in, is to plan their financing ahead of time. Especially, this is in particularly crucial when rules get tighter. When there is change, we have to manage that change, and we have to be proactive about managing that change. So having a financing plan in place before you actually put an offer is really, really important. And also understanding, if you want to grow a portfolio, understanding where is the money going to come from? How are you going to qualify for your second, third, and fourth deal? What terms are we working with? All of these things have to be clear, at least for your next 3 or 4 properties, before you go and shop and put offers, only because you don't want to go and put an offer assuming things and getting surprised in the midst of a deal. Or even if you get it financed, if you don't structure it correctly, you may have to reverse expensive mistakes later down the road. So planning is absolutely important when it comes to buying rental properties, and especially if you're looking to build a portfolio.
So more than ever before, it's important not just to start to plan, but also plan with an expert that understands how to navigate the new changes. So the new stress test is not really going to impede our ability as real estate investors to continue to grow our portfolios or to continue to invest in the real estate market. What it's just doing is changing how we do it. And we have to get more strategic, and we have to have the right people on our team.
Yeah.
So how can people get in touch with you?
Well, we are very reachable. Clients can either email us or call us. And on our website, also Streetwise Mortgages, we do have a contact us form. We provide everybody with a free consultation. We don't charge for advice. We help you plan things out so that you're well prepared and equipped, and you can, most importantly, execute on your plans and get closer to your goals.
Thank you, Dalia, for sharing your knowledge about the 2018 stress test.
Thank you, Rachel.